To remain updated with the latest business news, click on the bell icon.
Hello and welcome. You're with us here on Business Today and you're watching Ask Udayan, the show where we answer all your questions on stocks. I'm Abha Bakaya, with me, our global business editor, Udayan Mukherjee. The stock market has been seeing immense volatility. We take a look at what is perhaps the best approach at a time like this. And do keep sending in those questions. The number is on your screen. We'll try and answer as many as we can every week. Let's begin and take some of our queries now. Our first question today is from our viewer Ritu Tiwari in Mumbai. Ritu, go ahead.
Hi Udayan, this is Ritu Tiwari from Mumbai. I have 100 shares of IEX. I bought it at 264 and actually I've been incurring losses for a while, so I needed to ask you and have your suggestion. Should I exit this position? Thank you.
Well, IEX is a good company actually, Ritu. So I don't think fundamentally you need to worry too much. I know you're sitting on about a 15-20% loss on the counter, and that's never very comfortable. But IEX is fundamentally a good business. And as you know, since you own the stock, it's the leader in electricity exchanges with a 90% market share. And some new products and exciting products are coming on stream because derivatives have been allowed in electricity exchange contracts, trading contracts, because of the recent settlement between CRC and SEBI. And I think that opens up interesting possibilities for IEX as an exchange. Also, when the whole renewable units come on stream over the next few years, I think that will add another dimension to IEX's revenue stream going forward. And there are many good things about IEX, not just the fundamental story, but if you look at the quality of the balance sheet, absolutely pristine, debt-free balance sheet, 50% return on equity, you can't find fault with that. So the stock has corrected a bit too. I mean, it was at 320, you bought at 260 and is now closer to 220. But the only problem with IEX, I would say there are two problems. One is that the last couple of years, the company has grown at a scorching pace of 35%. Now, because of the base and other factors, I think growth will slow down. We'll probably still get growth, but maybe closer to 20-22% and not 35%. So maybe the valuations need to adjust for that. But the principal problem with IEX right now is that the stock is a very expensive one. And given that the market is seeing so much volatility, particularly in the expensive part of the market, I think IEX might also struggle to outperform in the near term. So what you could do is probably even average your position if you find the stock below 200 and probably look at it as a medium-term bet. Because as I said, fundamentally, it remains a fairly strong business, albeit with slightly slower growth.
Sarthak Verma has a query. He's from Raigad and this is on one of those banking stocks. Let's listen in.
Hi Udayan, this is Sarthak Verma. I bought 130 shares of Union Bank at Rs 38. Should I continue to invest in the stock for a long term of 2-3 years? Thank you.
Well, I think things are going for public sector banks after a long time. There's quite a bit of interest, as you can see in the market as well. I mean, stocks like SBI are outperforming names like HDFC Bank, and that's not happened in the last decade. So there is interest in public sector banks. There's a growing feeling that the balance sheets have been cleared. And now in the next credit cycle, as it fleshes out, you will see public sector banks actually reporting great earnings and catching up on the valuation front with private sector banks. And there might be a grain of truth to that as well. Union Bank is a very inexpensive name. I mean, I was talking about IEX just a while back, which was very expensive. Union Bank trades at half its book value, 0.5 times book, next year's book. So, you can't find stocks too much cheaper than that. They are also trying to fix their asset quality issues. There are still a couple of lingering issues with bad assets like Shrey Infrastructure and a couple of state government loans. So I think some of that will need to be dragged along for a while. But broadly, a large part of the asset quality cleanup has happened, and some kind of loan growth and earnings growth is beginning to kick in. My sense is that public sector banks will probably perform as a basket. Some may do better, some may do worse. But if the current mood continues and earnings hold up, maybe most good public sector banks, of which Union Bank can be called a part, should do well. So I wouldn't worry about throwing out the name Union Bank immediately, though I suspect that SBI and Canara Bank are probably better bets from the public sector banking universe.
Okay, and no wonder with all the volatility, we've got some questions coming in on Paytm. Deepak Shaw has this query. Go ahead, Deepak.
Hi Udayan. I had purchased Paytm stocks worth 1.5 lakhs at the listed price. So that is during the launch of the IPO. And as we know the story now, valuation is down by more than 60%. So at this stage, when the valuation has depreciated by more than 60%, my dilemma is should I continue holding the stock or should I sell it off? Because either way, the situation looks difficult for me.
Yeah, you have my commiserations, Deepak, because the situation is indeed quite difficult. There's no easy answer to this. The point is that Paytm, even after falling 60% down to 800 odd rupees, is still not showing a bottoming out process. It needs to find a level and settle down there. Every time it attempts a rally, there is more selling and the stock goes further down. So what you would like to see as a Paytm investor is some sign that the stock is trying to find a floor and to work with it. Now, whether the floor is 700 to 900 or 600 to 800, we don't know. But I would say this, that most of the price erosion in Paytm might have happened already, but it will need time now for it to form a base. That base formation has not happened already. And after that, you probably will see some kind of accumulation and pullbacks from longer term investors. There are two problems with Paytm at this point in time, Deepak, and both are difficult problems. One is that the near-term problem is that with the current results, what came through is that the company has actually taken fairly significant hits on its P&L because of ESOP grants, and most of the ESOPs have gone to its CEO promoter. And the way it is structured, it looks like the next couple of years, they will contribute to losses, hundreds of crores of losses, these ESOP grants as they continue. And that becomes another obstacle for Paytm to move towards profitability. The bigger problem, fundamental problem, is that while the payments business is doing well, Paytm's move to the financial services business is still not showing enough kind of traction. So they are doing lending, but that's all those BNPL small ticket loans. They're not making significant headway in large ticket consumer loans or merchant loans, which is what the market wants to see. So till you see demonstration of progress on the financial services front and some of these ESOP issues, ESOP loss issues blow away, I think Paytm will not give you significant outperformance. I think it will continue to grind in a range. You're probably better off looking at greener pastures because the market is correcting. You might find better value elsewhere.
Okay, Hemant Urdwaresh from Pune has a query on HAL. Let's listen into this one.
Hi, my name is Hemant Urdhwareshe and I am from Pune. My question is, I am holding 500 shares of Hindustan Aeronautics Limited bought at rupees 1348. What do you recommend? I can hold it for long.
I think there's a lot of interest in defense stocks at this point, sir, because I think what came through in the budget as well, if you notice that there is a great amount of emphasis on indigenization of equipment from the defense sector. I think for incremental equipment, capital equipment purchases, the level of indigenized component is about 68%. And that opens up opportunities for many of these listed defense players. And the top three, I would say, are Bharat Electronics, Bharat Dynamics, and HAL. I think these are the three premier defense companies. The order book for HAL is quite good. Recently, they have been bagging some significant orders from the likes of DRDO, the government of Mauritius, and even Bharat Electronics. And valuations are very cheap. I mean, there's not too many stocks in the market that you will find at P multiples of 12 and 13 like HAL is trading at. So good valuations, good space. The issue is that don't expect great growth from HAL. Despite the order book that I spoke about, HAL will probably still continue to grow its earnings by around 10 to 12% over the next 2 to 3 years. That's not phenomenal growth, but it's steady growth. So if you like a sunrise kind of sector with steady growth, I think HAL is a company that you can hold on for the medium term. I don't think earnings growth itself will deliver great stock appreciation, but maybe the stock will see some kind of re-rating given the mood and sentiment on defense stocks. Maybe the 12p, which I spoke about, goes up to 15p. That plus the 10-12% earnings growth can lead to a decent 15-17% kind of stock appreciation over a 2-3 year period. So if you're one of those steady type kind of investors, not expecting a rocket, then I think HAL could be one for the medium term for you.
Okay, that's all the time we have on the show today. Udayan, thanks for taking all those queries. And for those of you who do have questions around your stocks and investments, simply write into us at the number on your screen, and we'll try and answer as many as we can week on week.
If you like the video, do like, comment, share and subscribe.